All right, welcome everyone. So here is my thesis for Hertz. I have to say that I'm bearish on the company, particularly because the crazy bull run that we have seen over the past 10 days, I really don't think it's going to hold up. And there are quite a few arguments that I discuss in this video. I can be wrong. That's why you should never follow my bets, by the way. But I believe that there are some arguments that make me believe that this is going to come down probably to the 5 or to the 6, anywhere between 5 and 6 price level. So of course, this spike, this is not news for you because probably you know that. We have Bill Ackman who has a fund, Pershing Square. And this guy just released the 13F, the fund released the 13F, disclosing an ownership in Hertz of 4.1%. Essentially, they bought approximately 46.5 million in shares in the company, and now they own 4%. Okay, great. Now, is that enough to really justify a 125% increase in the share price? Or was this just another short squeeze? I mean, you can see here on Seeking Alpha, the short interest is 17%, which is quite high if you ask me. So was this a short squeeze, or is this the first indication of a turnaround where things are going to get better? I believe it's the first and not the latter. This is why. So we have Bloomberg, and this was a report from last Thursday. And it seems that according to the report, the company is looking to raise $500 million in debt. Okay, that's okay. Any company can raise debt. That's fine. The issue with the reports, by the way, here is the official press release from not official press release from the company, but from Bloomberg. Actually, the thing is that the company hasn't really disclosed this information in an 8K. This is just a rumor by Bloomberg, and this is key. So in the article, they say that the company is also exploring other options, including raising equity. And this is key, because if the company next week or in the next weeks, they file an 8K, okay, saying that they're planning to raise $500 million in debt and they're planning to raise X amount as equity, that will probably tank the share price. Not a lot, I gotta say, just a bit, but it will be considerable, particularly if you own puts in the company. And this is my main point. You probably know what happened in Q4 last year with the quantum mania stocks. Yeah, so you had a ton of companies that made no sense. People bought. I was one of them, by the way. People bought them at the beginning just because people were buying. Shit went up, and then what did the company do? The 4 companies, by the way. So these 4 companies, they started to dilute investors left and right, because as soon as share price is up, that's when it's best to issue shares, because the dilution is going to be less for the same amount of money, same amount of capital raised. So this kinda looks like that scenario, because you have a company that was trading for, to me, by the way, anything less than $4, anything less than $5 actually is a penny stock. Yeah, to me. To people, most people, they consider anything below 1 to be a penny stock, but to me it's anything below 5, because usually this is an exception, by the way. You can see by Pershing Square buying at an average price of, how much was it, like 3.5? Yeah, but usually funds, they don't buy when the share price of an equity is below 5. Usually, some of them, they have that disclosure in their investment style. So to me, anything below 5, it's quite sketchy. But that doesn't mean that I'm not buying it. Don't get me wrong. If the case makes sense, I'm in. All right. So essentially, we have that press release. Another factor that I see here is the decline in the U.S. airline travel. Okay, so we have passenger travels in the U.S. going down, and this is bad. Why? Because if you go to the 10K, the company is saying that about 66% of the worldwide vehicle rental revenues come from airport locations. Okay, so airports, you probably use Hertz. I'm not going to try to explain their business model. You probably know what's going on in the airports, and that's where they generate 66% of the revenue. Now, if you look at the breakdown of revenue per client segment, so we have business clients and leisure clients. Leisure accounts for most of the transactions, and of course most of the revenue as well, both in Americas, which by the way includes Canada, US, the Caribbean, and Latin America, and then international, 60% for leisure. This is key. Why? You can see here a risk disclosed by the company here at the top left. Probably you won't see it because it's too small. But essentially the company is saying that demand for airport rentals, again, 66% of revenue last year, is generally correlated with airline travel patterns. And transaction volumes generally follow airline passenger traffic. So what happens when passenger traffic goes down? Usually revenue at airports goes down. And that's the majority of the companies. That's where the company makes most of the revenue. So this is not attractive. Another point of my thesis was tariffs. The company was quite bullish on tariffs. I gotta say, I think I have here. I believe it's a mention by. Yeah, there you go. So this is a quote from management during the Q4 earnings call, and they said, if tariffs, they will say they increase new car prices, which seems to be the case. The counterbalance is likely the residual values will go up, which will help our business model. I agree. I really agree with them. So at the very least, I believe that tariffs, if maintained, which I don't think they will, but if they are maintained, I don't think it's going to really affect the company. Because if they pay more for cars, for brand new cars, because that's their business model, they buy new cars, they hold them 1-2 years, and then they sell them. But of course, if you have new cars being more expensive, resale cars are going to become more expensive because now there is market for resale cars. People are buying those because they are cheap, and they're cheap only for some time because then they're going to come up. So that's why when the company gets rid of their fleet, they're going to be able to sell them for more. So the company seems to be relatively bullish on tariffs. However, you can see, the U.S. administration being all over the place, and the guys are set to exempt car makers from some U.S. tariffs, particularly the ones on autos, and that's bad. It's bad first for the credibility of America. I mean, for God's sake, can we have an actual policy that's stable and that doesn't really change us and that gives you certainty as to what to buy, what not to buy? It's crazy. But the other uncertainty is with Hertz, because if the tariffs go down, I think that's going to probably hurt a little bit the outlook for those resale cars. And that was a good case for Hertz to offload cars. If prices go up for resale, you get rid of them. So another point, what was the whole deal? I believe, by the way, that the RIP that we have seen here, it was a short squeeze. That's my thesis. I'm sorry to say, I see high short interest. I believe shares went up because shorts had to buy back. The thing is that some reports, if you research that online, I cannot put links in Reddit, which is disappointing. But some reports are saying that essentially they believe that AI and the robotaxi infrastructure could be a new venture for the company. And they think that activist investors in the likes of possibly Bill Ackman are going to try to influence the company. So far, as I said before, they only own 4% of the company. If they own above 5%, that's when they have to file a 13G or a 13D. And I always forget if the 13D or G, I don't remember which one was active or passive, but essentially one of them, if the fund decides to influence the company, they will file that letter. I believe it's a G or a D, and in that filing, they will usually include a letter to management. And in that letter, they will say, okay, this is what we believe that you should direct your strategy. And some reports are saying that strategy should be focused around the whole robotaxi infrastructure nonsense. I put that word in my thesis because it's too early. I mean, yes, if the company wants to be the first one in the world to cater to that robotaxi segment by, maybe doing maintenance for robotaxis, or maybe charging robotaxis at night or when they need it. Yes, that's great. Don't get me wrong. It's a very nice bull case if you're planning to hold this company for like 10 years, which is probably what Bill Ackman is planning to do. But if you're like me and you have a time frame, of 3 months to 2 years, that's nothing. That's, in 2 years, nothing's going to change. Like the robotaxi business, Tesla has not even released their robotaxi in Austin. And I mean, they have done that with employees, but not with the public. So I don't know. By the way, Tesla, I believe that they try to do everything end to end in their. So all the infrastructure is going to be probably done by Tesla, the maintenance as well. I don't think they plan to collaborate with any other company, and that's noted in their, in their what will I say, in their refuse. They didn't want to go with Uber. You know what I mean? So if they refused to use Uber to to get the traffic for the clients, if they refuse that, that's bad, because the company, I believe they try to do it everything on their own. In any case, so these are the main points. Now, of course, revenue is down. If you look at the fundamentals, you can see the article. I'm not going to go through that in this video, but essentially we have revenues down year over year. The trend doesn't look really nice, I gotta say. Q4 24 is down 7.5, and this is Americas. Q3 is down 5%, Q2 down 4% year over year. And these are adjusted for seasonality. So I'm comparing Q4 24 to Q4 23. As you probably see here, there is seasonality in Q2 and Q3. Q3 is always the peak season. Q2 is close to the peak season. And then Q1 and Q4 are usually the same, but lower in revenue. And if you look at EBITDA, which is before depreciation, by the way, you will see here the trend last year, which is crazy. It's pretty much similar to 2020, even worse, I would say, particularly in the Americas region. And when you take into account depreciation, so what you're seeing here is earnings before taxes, but after depreciation and our expenses, it's crazy. I mean, it's negative 3.2 billion compared to negative 2 billion in 2020. So the company is doing worse now than in 2020. Think about that. So yeah, the company has a plan. Again, you can read this on my Reddit. I won't go into the details in this video, but they essentially have a plan to get back on track, and they have a back to basis roadmap. They have 3 different parts in the plan. So buy right, which means, you don't buy expensive cars. Okay. You hold right, which means you hold it for the right amount of time before you get rid of it. And when you sell it right, you sell it through that retail segment, or that's the goal. And you don't sell your cars through the auction process, which usually, of course, gives you poorer results. Now, the issue here is the depreciation trend. Yeah, so you have depreciation per unit per month. Essentially, what you see there is how much a car is losing value over the past, on average, in the past quarter during a month. It's a lot of words. There are a lot of words. Essentially, how much you lose the value of a vehicle per month on average during the quarter. And that's a lot, what you see there. And you can see, yeah, things are improving. Depreciation is going down. Yeah, that's fine. But it's still, to a level that's quite uncomfortable. So if you look at the total DPU trend since, let me have a look, since 2019, I believe. Yeah. So the median was about $253, which is quite good when you look at the value in Q4 last year. This is by the way, in orange is the total depreciation. Yeah. So this is both Americas and international. The value was $422 per month compared to the median of 253. That's really far away from the normal case. And if you take into account what has been going on since 2021, since after the pandemic, the median was 284. And, 422, it's still above that. And that doesn't look really nice, at least to me, and the target is to go down to 300 per month per unit by the year end. So this DPU That's their target, is to go down to 300 or less than 300. It seems that, according to the vehicles that they're buying, it seems that they're probably going to reach that goal, which will be good. But still, that's not below the median. So it's still high. And there are here more details on the hold drive strategy, where they say that 60% of the fleet had less than 1 year. So they were less than 1 year old vehicles, which is good. And then of course you have the sell right, and that's where they mentioned tariffs. But yeah, the bear case, as I said, I don't have just one pillar. There are many pillars to my case, but the main one, I will say, of course, the main one is actually this one with the equity offering. I think that's going to happen in the next few weeks. And if there is an equity offering, the share price is going to go down. But from a fundamentals perspective, when you look at utilization rates, things look actually quite positive. Wait, what? Just look at that. Look at the utilization rate, and this is the actual variation year over year. Okay, let me explain. So utilization rates are the same, which means people are still using the cars. The issue is that when you look at the actual revenue per unit, and I believe this is the revenue per transaction day, how much money a car is making per day, essentially, it's coming down. You see, so the trend here is pretty much neutral, but that value is coming down over the past 3 years. And you can see the actual year-over-year variation. Again, there is seasonality, so the reason why you see a seesaw pattern is because Q2, Q3 are very good, when Q4 and Q1 are bad. But yeah, essentially that's why you're seeing that. And then when you look at debt, just look at the interest payments. It's crazy. The increase is like double digits almost in each quarter last year. And it doesn't really look exciting. Then you look at maturities. Maturities are very close to coming to, in 26 I think we had a slide here. So these are non-vehicle debt maturities. So we have slightly over $500 million in 26. It's not a lot. But if you look at vehicle debt, so this is debt where I believe the collateral is the vehicle. 26, we have a lot of these maturities. Yeah, so we have essentially one here, $2 billion. That's on April in 1 year. Then we have another one at the end of 26. That's another $2 billion. So that's $4 billion already. And then we have another one, by the way, this year on September, and that's about $667 million. And these are, again, I believe the company is going to be able to refinance them. I don't think it's going to be an issue. But the issue here with debt is that if they refinance, maybe are they going to get better terms? Maybe. Let's see what happens with the interest rates. But this trend in interest expenses is not really attractive. And if the company doesn't get rid of debt and they just push it forward, this is still going to be a headwind to earnings. And yeah, so from a technical analysis perspective, as I said, I will be honest, I really don't trust that much technical analysis for this kind of plays. Is the share price going to test the 5? Maybe. Is it going to test the 5.5 or 6? Maybe yes. I don't have a clear answer to that. But I think it's going to be maybe around 5 based on this. And yeah, the RSI looks oversold. And here I have the profile of the June 20th expiration date, $7 put contract. And if the price goes down to, let's assume, 6 over the next few weeks, well, the return profile is quite attractive. We're talking about 60%, maybe 70%, somewhere around that. And in the worst case scenario that it goes, the worst case scenario is you lose it all. That's why you should never follow my bets. Never do that, because this is Vegas money. And I'm not trying to invest in this short plays that I publish here. So these are pretty much for informational purposes and for you to have a look at my thesis and at the quality of my thesis, which is low. I gotta say it's not a CFA level. So essentially, you can lose it all. And in the worst case, it goes down to 6, and you pretty much break even, that would be my case. So essentially, that's it. So that's my thesis on Hertz. I think that overall, the headwinds, so just to summarize again, possibly an equity offering, it could be a bad headwind for the current bull run, and I believe that's going to lead to a sell-off. Then we have, of course, debt, which we have a lot of maturities coming in. Again, I don't think there's going to be a liquidity issue. I just think the company is going to refinance them for later on, which means interest expenses are going to stay the same. Then we have, we have tariffs, which were bullish for the company because they can sell their cars for a higher price, which is going to decrease the depreciation. Then we have U.S. airlines, the reporting that they are cutting flights because travel across the country declined. That's bad because the company makes 66% of the revenue from airports locations. And aside from that, the whole hype around robot taxis and AI and all that, it's not, I believe, it's not aligned to the company's strategy of simplifying things. I mean, you already see my strategy. Let's see, what was it? I'm sorry. There we go. The back to basis. The company has a roadmap that's literally called back to basis. And now you come here and you say that you want to implement a robot taxi AI strategy. I mean, come on, it's crazy. So that's my opinion. I can be wrong. Yes, roast me in the comments, roast me on Reddit, somewhere around there, and that's it. Thank you for watching, and I'll see you in the next one.